Can the deferred sales trust operate at a loss? The answer is yes. Hi, I'm Brett Swartz, founder of Capital Gains Tax Solutions, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, and not having a clear plan is the enemy. And using a proven tax deferral strategy, such as the deferred sales trust, is one of the best ways, if not the best way, for you to exit highly appreciated businesses, real estate, primary homes, cryptocurrency, stock, so you can defer capital gains taxes and also eliminate estate tax if you're ultra high net worth, so you can create and preserve more wealth. In this episode, we're talking about the overall plan once the deferred sales trust is closed. So if you're looking at this for yourself or for others, you're going to want to understand not only the nature of the legality of the deferred sales trust before you go into it, and the audit defense and the track record, and then also the investments, which are really important as well, how the funds are going to be invested to get you the return on your capital, but also how the trust is going to have a tax return and what that's going to mean to you and the trust. And one of the most common questions is, Brett, I don't understand how the trust can operate at a loss. And if it can operate at a loss, that's great. But it seems like if it's earning some capital, earning interest, growing in its wealth, that it's going to have to pay taxes. And the answer is, well, it all depends. But most of the time it's operating at a loss. And here's why: because it's able to accrue the interest of what it owes to you, even if it hasn't paid you out. In fact, think of it like a business tax return or a corporate tax return or a business trust. It has income and it has expenses, and to the extent that it has expenses, right, that out earn or greater than the income and the dividends and the interest that it's earned on these investments, it's able to expense that. I mean, if you think of it like a multifamily property, if you own that, you have your cash flow, right? You have your income and you have your expenses, and that equals your cash flow. But that you also have what's called depreciation, which is, if you take what's called accelerated depreciation, using what's called cost segregation, and right now in 2022, by the way, you still have the last year to do bonus depreciation, which is a good time to consider that if you're selling something. But in that scenario, they're able to do a paper loss of depreciation to offset your income. And that's a beautiful way to, what we like to say, tax flow your situation, not just cash flow, but look for ways to deduct, look for ways to offset the cash flow, so you're not getting hit with huge tax. It's a beautiful way that businesses do this all the time. By the way, Amazon is famous for this, and they go out and they buy a bunch of other companies, or they invest in their own company, and they take a lot of their profits and they're just pouring it back into the company and continue to build and build and build and build, oftentimes operating at a loss every single year. Of course, they're creating more jobs, and those jobs are creating more tax revenue, and those do create more taxes for the IRS and the authorities. But that's kind of the idea here. So backing it all the way back down to the deferred sales trust, remember the nature of the deferred sales trust is that you are the lender. Right, you are the lender, which meant you loan the funds to the trust in exchange for the promissory note. That's your asset. And that promissory note, which I'm going to share on my screen right now, is an expense to the trust. In other words, what it owes to you is an expense, and that expense builds and it builds and it builds, and it actually starts to compound over time, because at the nature of it, it's typically an 8% compounding rate of return net of the fees. The fees can be about 1.5% to 2% per year, just depending on the amount that's in the trust and where and how the funds are invested. So if you think about this, you have one expense of this promissory note, which is 8% compounding on your money. Okay. And this is a sample deal, which the net proceeds, this particular deal actually was about a $7 million sale. They had a substantial amount of gain. They also had a substantial amount of tax liability that they wanted to defer, and so they were able to defer it. But what netted into the trust was about $3 million, and at an 8% compounding rate of return, you're going to see this accrued interest that's building up. And I want you to think about this accrued interest as an expense, because it is an expense to the trust. Remember, the trust is a separate entity from you, and it owes you this money, right? This 3 million plus this 8% compounding rate of return. And so you're going to see, as each month goes by, the interest is accruing. And this particular trust, we waited a few months to start the interest to pay out, right? So the payment date, by the way, is also different than the interest that's accruing. as well as the interest that's accruing is also different than what the actual investment performance is. Okay, so these are kind of the three things that we're working with here. But the overall concept of this video is how do we determine what the expense is for the trust in a given year, and how are we able to use that to offset the income or the interest and operate at a loss. And here's how. Okay, so let's start in month number 4/1, so April 1st, 2020. So it had accrued a little bit of interest between the day that it closed, and now all of a sudden it's a big interest that it accrued. And this month was about $20,000. Was any payment paid out to the note holder? No, nothing was paid out to the note holder. So it just accrued to a larger balance. Same thing in month of May. Another about that same amount accrued, but you see how this changed a little bit because now it's the 8% is compounding on the new number. And so now it has now this 3,045,389 in the month of May at the ending balance. And then we come down to period number 4, or June the 1st. We're accruing again about 20,302, a little bit more. And you see as this grows, this amount grows. And so in fact, in 2020 alone, if you just take 20,000, we'll keep it simple, by 1, 2, 3, 4, 5, 6, 7, 8 months. 8 months, so 20,000, just to keep it simple, about eight months is about $160,000 of an expense that's been accrued by the Deferred Sales Trust. So the question is, as well as another, about a point and a half. So let's call it 9.5 to 10%. That's accrued because of the fees that's paid to me, the trustee, and the financial advisor who's managing the account. So that's a big expense, right? Let's just take it say it's about $180,000 to $190,000. And so the question is, did the interest on the investments out earn that, or was it below, right? And that's a separate concept. But also on that, even if the growth of, like, for example, put it in some stocks or put it in some multifamily investments, they could have invested that $3 million. And it actually could build up to $4 million, let's say, but it hasn't sold those stocks or that real estate, even though the value might be higher on the investments. In other words, it's not actually received yet or recognized, the recognized gain, until it sells those positions. Okay, and so year in and year out, what this means, practically speaking, is that the trust operates at a loss, which is so powerful, right? Because imagine you live in California, and California is a very high tax state, right? And you don't want to necessarily be getting hit with huge taxes all the time. And so this deferred sales trust is like an IRA in this sense, in that you can park the funds or defer the tax. And you're going to wait to pay tax until you start receiving payments. And guess what happened here? So in 1/1/2021, start to receive payments. Okay. And this about 21,269 is the payout. They'll pay payments on this. They'll get a 1099 INT. Why? Well, because this is interest that's accrued, and this interest that's accrued is paid out as an ordinary income tax. So they get a 1099. So let's do quick math on that. 21,269 times 12. It's about $255,000 is the 1099. They report that to their CPA, and they pay tax on that. But again, it's the trust level. It's able to expense that, even if it hadn't paid them out. By the way, it could expense it, okay, because it's operating under the accrual method. But it did pay him out, and so that's an expense. It's a wash. It's not a double expense. It's just an expense. But the point is, it's able to operate at a loss, and so 99% of the time we're operating at a loss, which is a powerful thing of the Deferred Sales Trust. Because back to the other point, if you live in California or New York or a high tax state, the interest in which you receive and when you receive it, and the state in which you receive it in, is the state in which you pay the income tax in. So we have a deal that closed in Palo Alto for about $8 million, a primary home. And this particular client was planning on moving out of state. So he moved to another state, and that state happened to be a zero income tax state. And so he deferred the tax, okay, moved into the zero income tax state, and then started to receive the interest payments. And he received those in that new state. And so he's able to save a tremendous amount of tax. Now, if he ever dips into principal, that's where he's going to pay the capital gains tax. And so realize that you're not avoiding having to pay, California's capital gains tax. But until you dip into principal, you're in a deferral state. That's the whole essence of an installment sale based upon IRC 453. And that's why we love the deferred sales trust, because it's so tax efficient. And it's also important to understand this concept because it shows you how to make a deferred sales trust an investment and not an expense by focusing not only on your cash flow, but also on your tax flow. Again, like an IRA or 401k, and that you can keep not only the capital gains tax deferred, but you can keep the interest that it's accruing and building tax deferred, or in other words, income tax deferred until you receive it. And so we love the deferred sales trust for that reason. I'm hoping you're seeing that as well. And so we've just answered, how can the deferred sales trust operate at a loss? And also, how does the deferred sales trust operate at a loss? The answer is yes, it can. And how does it do it? It typically does it through the accrual method. And it's just accruing the expense that it owes to you, even if it hasn't paid you out. And on your side, you're deferring the tax until you actually receive payments from the trust. And so if we can help you at all, we want to encourage you to go to capitalgainstaxsolutions.com. You can start your deferred sales trust today. We also want to encourage you to join our community. We have a deferred sales trust mastermind or masterclass every single Friday, where we're breaking down new deals that we're closing every week. We're breaking down frequently asked questions. We are breaking the false beliefs of the deferred sales trust is too good to be true. How do I know it's legal? Is it worth it? Does it work? How long has it been around? All of those questions. We literally have an open forum of 5 to 20 people every single week that are just going through this deferred sales trust and trying to make it an absolute perfect fit for you. It's not a perfect fit for everybody. You do need to have a $1 million net proceeds, $1 million gain per transaction, unless you have 500 each on 2 properties. So we want to, just clarify for you what works. Also, check out the new book that's coming out. It's called Building a Tax Deferred Exit Strategy. And it's we've got a number of people that are in the book, like Kevin Harrington from Shark Tank, and financial advisors and commercial real estate syndicators and operators, multifamily experts. And it's really my story about the deferred sales trust and how it's come to change the life of my clients, and as well as my life as I build the business here at Capital Gains Tax Solutions. Hey, so appreciate you watching this video. Look for this, by the way, on Amazon in about 30 days. And please rate, review, subscribe. Please share this with someone it could be an encouragement to. And I look forward